Welcome back to MetalIQ, the channel where we cut through the noise, ignore the hype, and focus on what the precious metals market is actually telling us. If you're here for real signals, real data, and real-world developments in gold and silver, you're in the right place. Over the past year, we've watched history unfold in real time. Gold and silver haven't just moved higher, they've behaved in ways that challenge long-standing assumptions about liquidity, supply, and market stability. And what I'm about to share with you today is something that, in my experience, is a first coming from a major bullion dealer. This is not a rumor. This is not social media speculation. This is an official policy shift, and it matters. Many of you remember that I previously discussed unusual activity around order limitations at major bullion dealers. At the time, there was some confusion, and in at least one case, poorly worded communication created uncertainty around buyback policies. But what we're seeing now goes beyond wording. It represents a structural response to extreme demand. A major bullion dealer has now implemented a minimum purchase requirement just to place an order, and that alone should make you pause. Why? Because large dealers don't do this unless something fundamental is changing behind the scenes. Bullion dealers operate on volume. They thrive on accessibility. Limiting small orders is not good for business unless demand has reached a level where servicing everyone is no longer possible without sacrificing execution, delivery times, or inventory control. And that's exactly the environment we're in right now. Here's the key point I want you to understand early in this video. This story is not about one dealer. It's about what happens when physical demand begins to overwhelm systems that were designed for calmer markets. Gold and silver have recently pushed to new all-time highs, followed by normal pullbacks, and that volatility has triggered a surge of participation. But unlike previous cycles, this isn't just paper trading or speculative positioning. What we're seeing is real people demanding real metal, and the infrastructure is straining to keep up. When CEOs of major bullion firms release multiple policy updates within days of each other, that's not routine, that's reactive. That's management responding in real time to pressures that weren't forecasted months ago. And this is where MetalIQ takes a different approach from most channels. We're not here to shout price targets, we're not here to scare you into buying, and we're definitely not here to pretend that bull markets only move in one direction. Instead, we analyze signals. And dealer behavior is one of the most underrated signals in the precious metals space. When minimums rise, when buybacks tighten, when mint production slows, when delivery timelines stretch, those are not coincidences, those are symptoms. Now, before we go any further, I want to be clear, bullion dealers adapting to demand is not a negative judgment. In fact, it's understandable. Markets evolve, and businesses must evolve with them. But for us as observers and participants, these changes give us valuable insight into what's happening beneath the surface. Today, we're going to break down exactly what was announced, why it's unprecedented at this scale, and what it tells us about the current phase of the precious metals cycle, especially silver. Because whether prices go higher next week or pull back tomorrow, the structural story is already changing. And once you see it, you can't unsee it. Let's get into it. Now that we've set the stage, let's clearly define what has actually changed, because this is where a lot of people misunderstand what's going on. The headlines make it sound dramatic, but the real story is deeper and far more important than just a dollar figure. A major bullion dealer has now instituted a $500 minimum purchase requirement for online orders. In practical terms, that means if you're a small buyer or someone who typically stacks slowly over time, you are now effectively being filtered out, at least temporarily. This is not a pricing change. This is not a premium adjustment. This is a volume control mechanism. At the same time, on the buyback side, a $10,000 minimum remains in effect for selling metal back to the dealer. That combination matters. It tells us that this isn't about discouraging sellers or manipulating price flow. It's about managing operational stress caused by a surge in transaction volume. To put this in perspective, the dealer publicly stated that the most recent week was the fourth highest order volume in their entire history. Not just a strong week, one of the strongest ever recorded. Even more telling is that this volume was 40% higher than the week before, and their normal weekly average is roughly half of what they just experienced. That's not organic growth, that's acceleration. When volume grows at that pace, systems break, customer service suffers, delivery timelines stretch, inventory forecasting becomes unreliable. And for a dealer that built its reputation on efficiency and scale, those risks can't be ignored. What's particularly revealing is what happened after the buyback minimum was raised. Order counts dropped by roughly 20%, which is exactly what you would expect when you raise thresholds. But here's the part most people missed. Total purchasing dollars still went up. Even with fewer transactions, the total value of metal being bought remained historically high. That tells us something critical. Demand didn't disappear, it concentrated. Even with fewer tickets, those purchase volumes still ranked among the top 5 weeks in the company's history. And within that demand, silver made up a larger percentage of revenue than ever before. This is where the signal becomes impossible to ignore. Silver demand hasn't just increased, it has outpaced gold over recent weeks. Historically, gold leads during uncertainty, and silver follows later. What we're seeing now is silver stepping into a leadership role, not in price alone, but in physical demand. And that matters because silver markets are far tighter than gold, smaller inventories, less above-ground stock, fewer large players capable of absorbing shocks. When demand surges in silver, it stresses the system much faster. The dealer also disclosed that production at their own mint, which produces the majority of their silver bars and rounds, is expected to be cut by roughly 50% temporarily, pushing pre-sale delivery timelines even further out. That's not a supply collapse, but it is a bottleneck, and bottlenecks in tight markets tend to amplify volatility. Now, it's important to stay grounded here. This minimum purchase requirement is being described as temporary, potentially lasting only a short period, but even temporary measures tell permanent truths. Businesses don't introduce friction unless they absolutely have to. So while this policy may be rolled back, the conditions that caused it haven't disappeared. What we're witnessing is not panic, it's pressure. And pressure in physical markets has a way of revealing realities that paper markets often conceal. Moving forward, we're going to step back and look at the broader market implications and why dealer behavior like this often shows up before the most dramatic price moves, not after. To understand why these changes are happening now, we need to look beyond individual dealers and focus on the structure of the silver market itself. Silver has always been the more volatile, more reactive metal, not because it's speculative, but because it operates with far thinner margins of error than gold. Gold is a deep global market with massive above-ground stockpiles. Central banks hold it. Institutions warehouse it. Liquidity is everywhere. Silver, on the other hand, lives in a much tighter ecosystem. Inventories are smaller, industrial demand is constant, and much of the supply is consumed rather than stored. That makes silver extremely sensitive to demand shocks. Over the last several weeks, something unusual has happened. Physical silver demand has not just increased, it has accelerated at a pace that has outstripped gold, and that's historically significant. When silver begins to lead in demand rather than follow, it signals a shift in behavior. This is no longer just hedging or diversification, this is accumulation, and accumulation stresses the system. Bullion dealers sit at the intersection between wholesale supply, mint production, and retail demand. When pressure builds at that intersection, the first signs don't show up on price charts. They show up in policies. Minimum order thresholds, delayed shipments, reduced mint output, and selective order acceptance are all symptoms of the same thing, flow imbalance. Silver's problem, or its opportunity, depending on how you look at it, is that it doesn't take much imbalance to cause disruption. When even a modest percentage of buyers decide to hold rather than trade, available inventory tightens quickly. When production hiccups at the same time, the effect compounds. This is why dealer behavior is so important. Dealers have no incentive to restrict access unless the alternative is worse. Limiting orders risks alienating customers. It invites criticism. It creates friction. So when it happens, it tells us that demand is arriving faster than infrastructure can absorb it. What makes this cycle particularly interesting is that it's not being driven by a single event. There's no one headline, no singular crisis, no obvious catalyst. Instead, we're seeing a gradual awakening, a growing awareness that physical metals behave differently than financial assets, especially during periods of uncertainty. This kind of shift doesn't happen overnight. It builds quietly, first through increased inquiries, then through larger average order sizes, then through strained delivery timelines, and finally through policy changes that would have seemed unthinkable just a few years ago. Silver has spent much of the last decade being dismissed as stagnant, trapped in ranges, ignored by mainstream investors, and overshadowed by other assets. That complacency is now being challenged. When an asset moves from apathy to attention, the early stages are rarely smooth. It's also important to understand that rising demand does not guarantee uninterrupted price appreciation. Markets move in waves, pullbacks are normal, volatility is part of the process, but structural demand shifts tend to persist longer than short-term price movements. And this is where silver stands out. Unlike speculative rallies driven by leverage or momentum, physical silver demand reflects intent. People buying physical metal are not looking for quick exits, they're looking for ownership. That changes the supply-demand equation in ways that charts alone can't capture. Moving forward, we're going to connect these market mechanics to what they mean for investors and stackers, especially those entering the market during a strong bull phase, and why discipline matters more now than at almost any other time. Whenever markets move this fast, the biggest risk is not volatility, it's emotion. Rising prices, dealer restrictions, and headlines about shortages can create a sense of urgency that pushes people into decisions they wouldn't normally make. And in precious metals, emotional buying is one of the fastest ways to make long-term mistakes. Let's be clear about something important. The introduction of minimum order limits does not mean silver is running out. It does not mean dealers know something catastrophic is about to happen tomorrow. What it does mean is that demand has surged faster than operational systems were designed to handle. That's a very different message. And misunderstanding it leads to fear-based buying. For experienced stackers, this environment feels familiar. They've seen rallies before. They understand that premiums expand during high demand and contract when markets cool. They know that the best stacking strategies are built over time, not rushed during peaks. But for new buyers, this is unfamiliar territory, and that's where caution is essential. Silver is currently in a strong bull phase. There's no denying that. Momentum is real, demand is strong, and participation is increasing. But bull markets do not move in straight lines. They surge, they pause, they pull back, and they test conviction. Anyone entering the market right now needs to accept that price swings, both up and down, are part of the process. Buying silver out of fear is dangerous. Fear causes people to overextend, ignore premiums, and abandon strategy. The same ounce of silver bought in panic feels very different when the price corrects. That's why perspective matters more than prediction. This is also where expectations need to be realistic. Yes, silver could go significantly higher. Yes, supply constraints could intensify. But even in the strongest historical bull markets, periods of consolidation always appear. Markets breathe. They don't explode endlessly. The healthiest approach in environments like this is measured participation, understanding what you're buying, why you're buying it, and how it fits into a broader plan. Silver is not a lottery ticket. It's not a get-rich-quick asset. It's a form of wealth preservation that happens to experience powerful upside cycles. Another important distinction that often gets lost during rallies is the difference between price and value. Price moves daily. Value reveals itself over time. Silver's value is rooted in its monetary history, its industrial necessity, and its scarcity relative to demand. Those fundamentals don't change overnight, and they don't disappear during pullbacks either. This is why patience matters. Those who chase price often become disappointed. Those who respect cycles tend to stay confident even during volatility. The goal isn't to time the top or the bottom. The goal is to participate intelligently without letting market noise dictate decisions. Dealer policy changes are signals, not sirens. They tell us something is shifting, but they don't tell us everything. Interpreting them calmly, rather than emotionally, is what separates informed participants from reactive ones. Moving forward, we'll step back and look at the broader implications of what's happening right now, not just for silver prices, but for how people are beginning to think about ownership, risk, and financial resilience in this environment. What we're witnessing right now is not just a price move, it's a behavioral shift. For a long time, silver was treated as a stagnant asset, something people held, ignored, or even sold during moments of uncertainty. That dynamic is changing, and it's changing faster than most people realize. Across the market, there are increasing reports of buyers stepping in aggressively. Local coin shops are seeing lines. Online dealers are reporting record order volumes, and for the first time in a while, the dominant question isn't, should I sell? It's, how do I buy, and how fast? That shift matters more than price alone. When markets move from distribution to accumulation, it reflects a change in confidence. People are no longer viewing silver as dead money. They're beginning to see it as protection, optionality, and in some cases, opportunity. That doesn't mean everyone suddenly understands silver, but it does mean sentiment has clearly turned. What's interesting is how quickly this happened. Just months ago, silver struggled to hold interest. Prices hovered in tight ranges. Commentary was muted. Now we're seeing volatility, urgency, and participation all at once. Historically, those conditions don't appear randomly. They appear when underlying pressures finally surface. But this is also where discipline becomes critical. When a market attracts new participants, mistakes increase. New buyers often focus only on recent performance. They see price charts moving higher and assume momentum guarantees future gains. That's not how markets work. Momentum attracts attention, but sustainability depends on fundamentals and patience. Silver's fundamentals are strong. Industrial demand is growing. Monetary demand is returning. Supply growth is limited. Those are real forces, but none of them eliminate the reality of corrections, pullbacks, and periods of frustration. Anyone entering this market needs to understand that volatility cuts both ways. There's also an important psychological element at play. Many people who ignored silver at lower prices now feel pressure to act. That pressure can lead to rushed decisions, poor execution, and disappointment when the market pauses. This is why strategy matters more than timing. Stacking silver has always been about consistency, not excitement. The most successful participants didn't buy everything at once. They built positions over time, they accepted volatility, and they focused on ownership rather than short-term valuation. Another factor that shouldn't be ignored is trust. In times like these, people begin questioning systems, pricing, availability, counterparty risk. Physical silver appeals precisely because it removes layers of dependency. You own it, you hold it, there's no promise attached. That doesn't mean silver replaces everything else. It means it complements broader financial thinking. And that mindset shift from speculation to ownership is one of the most important changes happening right now. What dealer policy changes, record volumes, and rising interest all point to is this: silver is re-entering the conversation in a serious way. Not as hype, not as a meme, but as an asset people are reassessing in real time. When you step back and look at everything we've covered, one thing becomes clear. This moment in the silver market is not about panic, and it's not about prediction. It's about awareness. Dealer policy changes, record order volumes, production delays, and shifting buyer behavior are all signals. They're telling us that pressure is building, not that something is about to break tomorrow, but that the market is adjusting to a level of demand it hasn't dealt with in a long time. Understanding that distinction matters. Silver has a long history of being underestimated. It spends years being ignored, then suddenly demands attention. What we're seeing now feels like the early stages of that transition. Not a straight line higher, not a guaranteed outcome, but a meaningful change in how people are thinking about ownership, risk, and value. It's also important to keep expectations realistic. Strong markets invite strong opinions. Some will say silver is going to the moon, others will say it's already too late. The truth usually lives somewhere in between. Markets move in cycles, and even powerful trends pause, correct, and test conviction along the way. This is why MetalIQ exists. Not to sell fear, not to chase headlines, but to help you think clearly when information gets loud and emotions start to creep in. Whether prices rise next week or pull back first doesn't change the bigger picture. What matters is how prepared and informed you are when volatility shows up. If you're new to silver, take your time. Learn how the market behaves, understand premiums, liquidity, and why physical ownership is different from paper exposure. If you've been stacking for years, stay disciplined. You've seen this before. You know how quickly sentiment can flip in both directions. The most important thing is this: don't let urgency replace strategy. Silver rewards patience far more often than it rewards impulse. As always, I want to hear your thoughts. Have you noticed changes at your local coin shop? Have dealer policies affected how you buy or sell? Drop your experiences in the comments. This community learns from each other. If you found value in this breakdown, make sure to like the video, share it with someone who's trying to understand what's happening, and subscribe to MetalIQ for clear, honest analysis on precious metals. Thanks for watching, and stay sharp.